Most people use the RSI completely wrong. Let me guess. When it's overbought, you sell. When it's oversold, you buy. Sound familiar? Well, that's exactly why so many traders lose money. But don't worry. I'm going to show you the real way to use the RSI the way it's meant to be used. First, let's talk about what the RSI, or Relative Strength Index, is. The RSI is a simple but powerful momentum oscillator that measures the speed and change of price movements. Its values range between 0 and 100, making it easy to visualize when a market is gaining or losing strength. Traders love the RSI because it highlights two key conditions: overbought and oversold. When the RSI crosses above 70, the market is considered overbought, meaning the price might be due for a reversal, so traders look to sell. Conversely, when the RSI drops below 30, the market is considered oversold, meaning the price could bounce back, so traders look to buy. Simple, right? Except, it's not that straightforward. Here's the problem. The RSI can stay overbought or oversold for an extended period, especially during strong trends. And that's where so many traders fall into a trap. Take a look at this chart. Notice how the RSI moved above 70 into the overbought zone. If you followed the typical strategy and sold right here, thinking the market was about to reverse, you would have lost money. Why? Because instead of reversing, the price kept rising, and the RSI stayed overbought for a long time. That's the nature of strong trends. The RSI reflects momentum, not an immediate reversal. The same mistake happens in downtrends. When the RSI falls below 30 into the oversold zone, some traders buy, expecting the price to bounce back. But they often lose out as the price keeps dropping and the RSI stays oversold. This shows why it's not a good idea to rely only on overbought or oversold levels. The RSI is a momentum tool. It measures the strength of a trend, not when it will end. Therefore, the RSI should be used in a different way, and that way is divergences. Divergences occur when the RSI and price action disagree, signaling a potential momentum shift, but not necessarily a reversal. And this makes perfect sense when you think about it, because the RSI is a momentum indicator. Its primary function is to measure the strength of price movements, so when a divergence appears, it's often a sign that the momentum driving the current trend is either slowing down or shifting direction. There are two types of divergences: regular and hidden. Regular divergence often signals a possible reversal. This happens when the price makes a lower low, but the RSI forms a higher low. It's a sign that selling momentum is weakening, even though the price keeps falling. Hidden divergence, on the other hand, suggests the trend will continue. If the price makes a higher low, while the RSI forms a lower low, it indicates the pullback had stronger bearish momentum, but the overall uptrend is still strong. In this case, hidden divergence gives us more confidence that the trend will carry on. Now here's where a lot of traders get it wrong. Most traders overlook how the RSI's settings impact the accuracy of divergence signals, and that's a big mistake. By default, the RSI is set to a 14-period length, meaning it calculates momentum based on the last 14 candles only. Any divergence you spot is limited to what happens within this specific 14-candle window. For example, on a 1-hour chart, if your RSI is set to 14, it will only show divergences within the most recent 14 hours of price action. If the RSI is set to 14, it doesn't account for divergences that occur over, say, a 20-candle or 30-candle trend. This is because the RSI calculates momentum based solely on the most recent 14 candles, ignoring any price action outside that range. It's a fixed look-back period, meaning trends or divergences spanning longer timeframes are effectively invisible to the indicator unless the settings are adjusted. By aligning the RSI settings, you ensure that divergences are more accurate and statistically significant. This way, you're comparing momentum and price action over a consistent period, avoiding false interpretations and missed opportunities. Now let's talk about how to make divergences even more reliable. The first step is to combine divergence with price action. For example, in a downtrend, imagine the price makes 3 consecutive lower lows. But notice something. Each drop to a new low is getting smaller. This indicates that the momentum behind the selling is weakening. If the RSI forms a bullish divergence at the last low, it's a much stronger signal that the price may shift direction. But we don't stop there. To confirm the signal even more, we look for candlestick patterns that align with the divergence. Candlestick patterns are essential for spotting reliable entry points. If you want to learn about the most effective candlestick patterns for trading, check out the video I've linked in the description. For now, we'll focus on one of the most powerful patterns, the engulfing candle. If we see smaller price drops, followed by a bullish divergence where the RSI forms a higher low as price makes a lower low, it signals weakening selling momentum. Add to that a bullish engulfing candle at the final low, and you have a high confidence setup for a potential reversal. This combination of smaller drops, divergence, and candlestick confirmation is your entry signal. Place your stop loss just below the most recent low to protect your trade, and with the momentum shifting, you're now positioned to ride the trend in the right direction. Secondly, the RSI can be used for spotting momentum in uptrends and downtrends. Forget about overbought and oversold zones for a moment. Instead, focus on the 50 midline, which is the true signal for trend direction and momentum. In fact, using the midline this way aligns with the RSI's original intention to measure momentum shifts and indicate the trend. When the RSI stays above 50, it confirms an uptrend. Below 50, it confirms a downtrend. But the 50 line does more than just indicate the trend. It also acts as dynamic support or resistance for momentum. Imagine the RSI is in an uptrend, holding above the 50 line, confirming bullish momentum. Suddenly, it dips back to 50 or slightly below. Does this mean the trend is over? Not necessarily. Often the 50 line serves as support, and momentum will resume. To confirm this, we use candlestick patterns again. For now, let's focus on the engulfing pattern again. If you spot a bullish engulfing candle near the 50 line, that's your entry signal. Place your stop loss just below the previous low, and boom, you have a winning trade. So instead of relying solely on overbought or oversold levels, you're now using the RSI as it was meant to be, a powerful trend indicator. Combine it with precise candlestick signals, and you've got a strategy that helps you trade with clarity and confidence.